Meet Bob. Bob is, statistically speaking, the unluckiest investor who has ever lived. Bob isn't bad at saving money. In fact, he's great at it. But Bob has a terrible secret. He is terrified of losing money. So, he waits. He sits in cash, watching the market climb, waiting for the perfect moment to jump in. And every single time he finally builds up the nerve to invest, disaster strikes immediately. I'm talking about investing his life savings right before the crash of 1973. Then again right before Black Monday in 1987. Then the dot-com bubble. Then the great financial crisis. Bob literally only buys at the absolute peak every single time for 40 years. You would assume Bob died broke. You would assume his portfolio was decimated. But you would be wrong, because when Bob retired, he was a millionaire. Today, I am going to show you the math behind the world's worst market timer and why being smart about entry points might be costing you a fortune. This sounds like a campfire ghost story for economists, but it is actually a rigorous data simulation created by Ben Carlson over at A Wealth of Common Sense. It's a stress test for the one question I get asked more than any other. Tom, the market is at an all-time high. Shouldn't I wait for a dip? It feels intuitive. We want a bargain. We want to buy low and sell high. But the data I am about to walk you through proves that your intuition is actually your portfolio's worst enemy. We are going to look at 4 distinct characters in this story. We have Bob, the terrible timer. We have Lucy, the impossible perfect timer. We have Susan, the boring consistent investor. And then we have the person most of us actually act like, Dave, the guy who stays in cash. By the end of this video, you are going to see a graph that changes how you view risk forever. Before we dive into Bob's tragic timeline, I want to ask you to do something that has a guaranteed ROI. If you appreciate data-driven stories that don't rely on hype or fear-mongering, go ahead and hit the subscribe button. It tells the algorithm that we want more signal and less noise in the finance space. I read the white papers so you don't have to. Okay, let's go back to 1970 and meet Bob. Let's set the scene. It is 1970. Bob is 22 years old. He has just started his career. He decides he is going to be responsible. He plans to save $2,000 a year. Now, $2,000 in 1970 is real money. That's a new car. But Bob is nervous. The headlines are scary. So he puts that money into a bank account. He doesn't trust the stock market. He watches 1970 pass. Then 1971. The market is going up, and he feels like he's missing out. Finally, at the very end of 1972, he can't take it anymore. The fear of missing out gets him. He takes his accumulated savings, $6,000, and he dumps it all into the S&P 500. It is December 1972. If you know your market history, you know that Bob just walked into a buzzsaw. Almost immediately after his check clears, the market collapses. We are talking about the brutal 1973-74 bear market, where stocks lost nearly half their value. Bob is horrified. But here is the key to Bob's psychology, and this is the one rule he follows that saves his life. Bob does not sell. He feels sick, but he doesn't hit the panic button. After that burn in the 70s, Bob is traumatized. He goes back to saving cash. He doesn't want anything to do with stocks. He works hard, he gets raises, and he increases his savings rate. Throughout the 80s, he's saving $4,000 a year, just letting it pile up in a bank account. He watches the massive bull run of the mid-80s from the sidelines. Finally, in 1987, the euphoria is everywhere. Everyone is making money but him. He decides it's time to get back in. He takes 15 years of savings, a huge lump sum, and invests it into the S&P 500. The date? August 1987. The market peaks immediately, and 2 months later, we get Black Monday. The market crashes over 20% in a single day. Bob has done it again. He bought the absolute top. But, sticking to his rule, he grinds his teeth and holds on. He doesn't sell. He just goes back to work, saving his cash, waiting for the next time he feels safe. This pattern continues. He waits until the absolute peak of the dot-com bubble in 1999 to invest his 90s savings. Then he waits until October 2007 to invest his 2000 savings, right before the global financial crisis. He literally catches every falling knife, but he catches them by the handle. Let's look at the actual ledger here. Bob invested a total of 4 times over his career: 1972, 1987, 1999, and 2007. In every instance, the market crashed immediately after he bought. By the time he retires in 2013, he has contributed a total principal of $184,000. That is the cash that came out of his paycheck. Now, keep in mind, for huge chunks of time, his money was sitting in cash earning almost nothing while he waited for these peaks. His timing was, objectively, an F-. If you were a fund manager with this track record, you would have been fired in 1974. But Bob isn't a fund manager. He's a guy who wants to retire. So, we run the numbers using historical S&P 500 total return data, which includes reinvested dividends. We calculate what that $6,000 from 1972 is worth, plus the 1987 lump sum, and so on. Even though he bought at the highs, he never sold. He let the dividends reinvest. He let the decades roll by. When he checks his balance in 2013, what do you think he sees? In 2013, Bob's portfolio is worth $1.1 million. Let that sink in. The world's worst market timer, a guy who only bought at the peaks of the worst crashes in modern history, is a millionaire. He turned $184,000 into $1.1 million. That is roughly a 6-fold increase on his capital. How is this mathematically possible? It comes down to the one variable that Bob got right. He got the timing wrong, but he got the time right. That money from 1972? It sat in the market for 41 years. Even though it lost half its value in the first 2 years, it compounded for the next 39. The money from 1987 compounded for 26 years. The sheer force of the market's long-term upward trajectory, combined with dividend reinvestment, completely overpowered his terrible entry points. The lesson here isn't that entry price doesn't matter. Obviously, buying lower is better. The lesson is that entry price matters infinitely less than holding period. Now, I know what you're thinking. You're thinking, okay, Tom, Bob did well, but surely he left a lot of money on the table. And you're right. But here is the twist. There is a character in the simulation who does worse than Bob. Much worse. And this character represents how most people actually behave. While we laugh at Bob for buying at the top, there is a legitimate danger in trying to be too smart. We need to compare Bob to his friends to really see where the trap lies. Let's bring in Lucy, Susan, and Dave. Because if you aren't careful, you might think you're trying to be Lucy, but the math says you're probably going to end up like Dave. First, let's look at the fantasy. This is Lucy. Lucy is God's favourite investor. In this simulation, Lucy invests the exact same amount of money as Bob during the exact same years. But Lucy has a crystal ball. She times the market perfectly. She invests her savings at the absolute bottom of every crash. She buys the 1974 low. She buys the 2002 bottom. She buys the absolute floor in 2009. Obviously, Lucy ends up with the most money. In Ben Carlson's model, she ends up with just over $1.5 million. That is the ceiling. That is the absolute best case scenario if you were a time traveller. But here is the comparison that matters. Bob, the idiot who bought the peaks, has $1.1 million. Lucy, the god-tier genius, has $1.5 million. The difference between being the worst investor in history and the best investor in history was not 0 versus millions. It was the difference between being rich and being slightly richer. The gap is surprisingly small, considering how drastically different their strategies were. Now let's look at Susan. Susan doesn't care about the market. She doesn't watch CNBC. She doesn't look at charts. Susan just invests her savings every single year as she earns it. This is what we call dollar cost averaging, or DCA. She buys when the market is high. She buys when it's low. She buys when it's boring. She just puts the money to work immediately. How does she fare? Well, she ends up with about $1.3 million. She beats Bob, obviously, because she bought some shares at lower prices. But she trails Lucy, the perfect timer. Susan is the baseline. She represents pure discipline without prediction. And notice how close she is to the perfect scenario. She got most of the upside of Lucy without needing a crystal ball. But Bob, poor unlucky Bob, is still trailing her by only a relatively small margin. This reinforces the idea that the penalty for bad timing isn't actually fatal, as long as you stay on the ride. And finally, we have to talk about Dave. Dave is the one you need to worry about. Dave is the one who says, "The market looks expensive. I'm going to wait for a crash." But unlike Bob, who eventually buys, Dave keeps waiting. Or perhaps he buys, sees a crash, gets scared, and sells to preserve capital. If Dave sits in treasury bills or a savings account because he is too scared to invest, he ends up with a fraction of what Bob has. If he stays in cash, he barely beats inflation. He ends up with maybe $400,000 or $500,000, depending on interest rates. Bob, the worst investor in the world, has double or triple the wealth of Dave, the prudent saver who stayed on the sidelines. This is the punchline of the entire study. It is better to be in the market at the wrong time than to be out of the market completely. The opportunity cost of sitting in cash is the most expensive mistake you can make, far more expensive than buying at a peak. I want you to visualize this bar chart. On the far left, you have the tiny bar for Cash Dave. Then you have a massive jump up to Bob, $1.1 million. Then a small step up to Susan, $1.3 million. And a tiny step up to Perfect Lucy, $1.5 million. The huge leap happens simply by moving from cash to stocks, regardless of timing. The incremental gains from getting the timing right are marginal compared to the gain of just being invested. The data suggests that we spend 90% of our mental energy worrying about that small gap between Bob and Lucy, trying to optimize our entry, when we should be spending 100% of our energy ensuring we aren't Dave. We obsess over the icing and forget to bake the cake. But Tom, you might say, I can do better than Bob. I can jump out before the crash and jump back in at the bottom. That is the dream. But I have another set of data that makes this strategy look terrifying. It turns out, if you try to dodge the bad days, you are statistically almost guaranteed to miss the best days. And missing the best days is lethal. Let's look at a study from Johnson & Zuber regarding the best 10 days of the market, because this is where the market timer's grave is actually dug. Here is the setup. They looked at daily returns over a 20-year period. If you just held the S&P 500 for the entire 20 years, your return was around 11.8% annually. Fantastic. But if you missed just the 10 best days in that 20-year period, that's 10 days out of roughly 5,000 trading days, your return drops to 9%. You lost nearly a quarter of your annualized return by missing 10 days. If you miss the 50 best days, that's just 1% of the trading days. Your return collapses to roughly 2.4%. You made less than inflation. You effectively made no money. Think about that. 99% of the days were noise. The entire compounding engine of the stock market was concentrated in just 1% of the trading days. If you are sitting in cash waiting for the right time, and one of those days happens, you can never get that return back. It's gone forever. Now, the counter-argument is, well, I'll just avoid the 10 worst days. And yes, the math says if you avoid the 10 worst days, your returns skyrocket. But here is the trap, and it's a nasty one. The best days and the worst days are roommates. They almost always happen right next to each other. JP Morgan Asset Management does a study on this every year. They found that 6 of the 10 best days in the market occurred within 2 weeks of the 10 worst days. In 2008, for example, we saw massive single-day crashes, followed immediately by massive single-day rallies. If you panic and sell on a Monday because the market dropped 4%, and you sit in cash on Tuesday, you might miss a 5% rebound. You locked in the loss and missed the recovery. This is why timing is so hard. To time the market, you have to be right twice. You have to sell before the crash, and you have to buy back before the rally. And since the rally usually happens while the world still feels like it's ending, almost no one has the guts to buy back in time. Let's play out the psychology of a market timer. Let's say you are smart. You sell everything in 2007 before the crash. You feel like a genius. The market drops 20%, then 30%. You are sitting on cash, feeling great. But when do you buy back? The news is terrible. Banks are failing. Everyone says it's going to zero. Do you buy then? Probably not. You wait for the dust to settle. You wait for confirmation that the economy is safe. By the time the news looks good again, the market has usually already rallied 40 or 50% from the bottom. You missed the snapback. This is why most retail investors underperform the very funds they invest in. Dalbar studies consistently show that the average investor lags the S&P 500 by 4 to 6% per year. They aren't losing money because the fees are high. They are losing money because they are jumping in and out, trying to outsmart a system that rewards patience, not activity. So what is the protocol here? It's what I call automated apathy. You need to structure your financial life so that you literally do not care what the market did today. If you are contributing to a 401k, this is already happening. You buy every 2 weeks, regardless of the headlines. You need to apply that same logic to your IRA, your brokerage, and your savings. The goal is to maximize your time in the market. Every day your money sits in cash, you are fighting the probability that today might be one of those best 10 days. Bob became a millionaire because once he put his money in, he lost the password. He never sold. If he had sold in 1974 to stop the bleeding, he would have locked in a loss and missed the 1980s boom. The protocol is simple. Buy right now. If it drops tomorrow, buy more. If it goes up, buy more. Just keep buying. There is one final objection I need to address, and it's a big one. It's the lump sum problem. Let's say you sell a house or get an inheritance, and you have $100,000 in cash today. The market is at an all-time high. It feels reckless to dump it all in at once. Surely, in this specific case, it is better to drip it in slowly over 12 months. It feels safer. It feels responsible. But Vanguard ran the numbers on this too, and the answer might make you uncomfortable. Vanguard compared lump sum investing versus dollar cost averaging, or phasing in, over a 12-month period across 3 different markets: the US, the UK, and Australia. Their conclusion? Lump sum investing outperformed dollar cost averaging about 66% of the time. 2/3 of the time, you end up with more money if you just hold your breath and buy it all on day one. Why? Because the market goes up more often than it goes down. If you decide to spread your investment over 12 months, you are keeping a large portion of your cash on the sidelines. If the market goes up during those 12 months, which is statistically the most likely outcome, you are just buying in at higher and higher prices. You are paying a premium for emotional comfort. Now, notice I said 66% of the time. That means 33% of the time, phasing it in actually works better, usually during a bear market. But are you willing to bet against the 2/3 probability? However, we have to respect the psychology. If dumping $100,000 into the market today is going to make you lose sleep, or worse, panic sell if the market drops 5% next week, then don't do it. In this specific case, dollar cost averaging acts as insurance against your own behavior. It is mathematically suboptimal, but psychologically superior. If spreading it out over 6 months keeps you invested, then do it. But understand that you are paying a fee for that peace of mind in the form of likely lower returns. Just don't drag it out for years. The data shows that the longer you wait, the worse your odds get. So, let's bring it all back to Bob. Bob is a hero. Not because he was smart, he wasn't. He was a hero because he was stubborn. He endured the 1970s stagflation. He endured the 1987 crash. He endured the tech wreck. He endured the housing crisis. And he did it without selling. That stubbornness is the most valuable trait an investor can have. The media industry is built to destroy that stubbornness. They want you to click. They want you to trade. They want you to feel anxious. But the graph of Bob's portfolio is the ultimate shield against that anxiety. Whenever you feel the urge to time the market, just remember the red dots on Bob's chart. He bought the peak. He lost half his money on paper. And he still won.
If you are young, market crashes are actually a gift. They let you buy more shares for the same amount of money. If you are older, a diversified portfolio protects you. But for everyone, the rule remains the same. The only people who get hurt on a roller coaster are the ones who jump off while it's moving. Stay in your seat. Let the compounding happen. Don't try to be Lucy. You don't need to be perfect to be rich. You just need to not be Dave.
If this perspective on Bob helped lower your blood pressure about the current market highs, do me a favour and like the video. It helps the channel grow, and it helps me find more of these studies for you. And if you have a friend who is currently sitting in cash, waiting for the election, or waiting for the crash, send them this video. It might save them a lot of money in opportunity cost. Thanks for watching, and I'll see you in the next one.